Welcome back, everyone. My name is Cary Williams, Portfolio Manager with North Road Investment Counsel, and I am joined today by my colleague, Marshall McAlister, Portfolio Manager and President at North Road Investment Counsel. Marshall, how are you today?
Doing well, Cary. Thank you very much for the intro. I'm looking forward to the year in review webcast for our clients. We have lots of interesting updates to give today.
Yeah, I'm excited too. I think this is by far of the webcasts we do, this is by far the most popular one. So I'm sure there's going to be lots of folks watching. Today, we're going to do a bit of a firm update for everybody right at the beginning. We're going to talk a little bit about registered accounts, capital gains, inclusion rates, some of those things that happened this year on personal finance. Then we're going to hop into what did returns look like around the world, different asset classes, maybe a couple surprises. We're going to throw in maybe some Bitcoin towards the end to talk a little bit about what happened in Bitcoin because we've had a few questions on that from clients. But for the most part, we're going to talk about factors. We're going to talk about the things that we think are important within markets. And if possible, Marshall, for once, in the history of North Road, we're going to try and wrap it up within 30 minutes instead of going for the full hour that we often do. We've decided to split this into two sessions. We're going to do a 2024 year in review today, and then in a few days you'll see in your inbox looking forward 2025 and beyond as we talk about some of the trends that are happening. So stay tuned for a two-part series. Marshall, I'm going to turn it over to you. Why don't you give a bit of an update on the firm and some of the new things that have been happening that we're so excited about?
I'd like to give special mention to Josh Morez as he's made some very, very interesting and great updates to our website. Cary, you're going to bring that up in the slides, and
Right now.
as we're going to be showing you, we've got four key divisions in North Road. We are an investment counsel firm, so obviously the finance and investment counsel is what we lead with. But we've also added some criteria around insurance, digital risk advice, financial planning as well. So as people navigate our website, you'll be able to see all four of those different categories.
So Marshall, one of the things I love about what Josh has done, I mean, the visuals are really, really impressive on the website, but one of the things I love is he set up these navigation bars at the top so people can really quickly find what they're looking for. So the What We Do section talks about the services you're bringing up. We've got some information on upcoming events. So for folks that might be in Mexico, as an example, you're hosting some events down there, which is fantastic. A little bit on our team under the Who We Are. And for anyone who's kind of new or has recommended perhaps a friend reach out to us, they can get in touch with us right through the top of the website.
Yeah.
Moving on from there. Yeah,
yeah,
go ahead.
so the digital risk advice side of our business, we've had a lot of communication about that. We won't spend much time about that, but we would like to highlight the fact that we've launched a digital risk quiz within our website. And going to our site, you can click on the button to take that quiz. We also have put in a QR code. So you can pause the video, take a picture of this QR code to jump right to our quiz. We'd like you to take the quiz, get a score around what your digital risk life is looking like today, and that'll help us provide services to you in the first and second quarters of 2025.
Marshall, let me hop in really quickly. Our colleague Misha, as you know, Marshall, but maybe lots of folks don't know, has spent about 6 months building out this program and really making it tip top. So this quiz that's on the website is 10 questions. It's really fast. It's about a third of the total assessment that he's doing when he sits down with clients, but it gives a good idea of what are the key areas I should be thinking about for my digital online life and the areas of risk in my life. One of the things that I think he's discovered and communicated to me that I just found fascinating is he said, listen, folks who have had success in their life can use money, as all of us can reduce some of the risk, frictions, all of those things in our life that money makes a little easier. He said, except for digital risk. It's like digital risk amplifies when we have more money because we become a target. And so I think us providing this quiz online that people can share, send it out to their friends and family, people they care about, is an awesome opportunity to start making lives better. So I'm really excited to hear what people think about it.
Yeah, I agree. I believe the next slide is going to talk about our world and our work in insurance. So for for 20 years, we've been giving insurance advice, but late last year, we moved the insurance licenses directly into North Road. So North Road now has the legal authority to give insurance advice directly. So we are providing advice on life insurance, disability insurance, as well as annuities. And this is all very important advice that we want to be able to provide directly to our clients. Some big changes in tax rules were announced last year. Primarily of importance is the capital gains inclusion rate, which we are now seeing move to 67% for corporate accounts. And then for any gains greater than $250,000 for individuals, those will be now have an inclusion rate of 67%. Thankfully, the personal gains will remain at 50% for gains below $250,000. So for you, Cary, and I, we have some new planning considerations that we need to make for large gains that need to be transacted either immediately or through time, something that we need to consider. Depending on what happens with a change in government, there is a chance that this will not be brought into official law, but we are reading that the Canada Revenue Agency is treating the capital gains inclusion rate as an official change.
Yeah, Marshall, one of the things that I think has been maybe not surprising, but interesting for me at the very least is we've always had conversations with families about how do they deal with tax on taxable assets in their estate. So if they have a cottage, let's say, that's gone up a lot in value, how do they make sure that stays in the family when there's going to be a tax bill due? We've always talked through those kind of things. That conversation, though, has come up a lot with this change in inclusion rate. And our ability to provide some advice around, should it be insurance that helps with that? Should it not? How do we walk through all the different options? I've had lots of those conversations this year, and I think clients have really valued hearing about the different options for helping to manage some of that tax load.
Yeah, absolutely. And even, a reasonably high amount of gains were taken in 2024 just to get ahead of the increasing inclusion rate.
Yeah, that's right. The other thing I thought we should mention, Marshall, is, as always, tax reporting from us as tax summary. We're preparing that, working through the bugs as we speak. So we're hoping that will be very timely for everyone to pass on to their accountants so that accountants can have an easier job reconciling tax slips. Keep in mind, tax slips are going to come from the custodians and from mutual fund companies. So starting to think about that tax planning as far as reporting and collecting information is really valuable.
Yeah, absolutely.
Marshall, let's talk about registered accounts. We, thankfully, I would say, keep getting opportunities to help ourselves and our friends and our families with planning around registered accounts. Unfortunately, that also keeps getting more complex. So we've got another set of acronyms to talk to folks about. TFSA, RRSP, FHSA. All of these sort of jargon terms are out there. Let's go through each one and chat a little bit about what folks should need to know this year.
Okay, I'll take the first one. So tax-free savings account, the limit this year is $7,000. It stayed the same. Maybe next year we'll see that increase up to $7,500, but we'll have to see what the level of inflation is. We are recommending that our clients add dollars into the tax-free savings account right away. And I know the first 3 weeks of 2025 has seen a lot of that activity already happen.
Absolutely. And so $7,000 for this year, a total of $102,000 for adults if they've been over the age of 18 since the start of the program. So lots of room here for us to benefit our future selves by getting money invested that can grow and not have tax paid on it in the future. Yeah. RRSPs, of course, are another tool, registered retirement savings plans. Deadlines this year in 2025 are March 3rd for early in the year contributions that can also be used on your 2024 taxes. Maximum value to contribute to an RRSP, $31,560. even though March 3rd is the deadline, we always recommend folks just put in their brain end of February. Don't leave it to the last minute. Get this thing done.
Yeah.
It can be really stressful for clients and for us if clients are contributing at the very last minute.
Yeah. The first home savings account was introduced in 2023, I believe, for a maximum contribution amount of $40,000. It's a deductible contribution, just like an RRSP is to income. The special wrinkle is there's a maximum amount of $8,000 that can be contributed in any one calendar year. And if you don't use that amount within 2 years, you'll lose the $8,000 room. So if the plan is to kind of use savings for a down payment for a home, it's important that our clients connect with their 18-year-old or 19-year-old children to start thinking about this planning. And yeah, you and I, Cary, want to be in the mix on those decisions if we can.
For sure. Yeah. All right. Lots of opportunity there for us to work within the tax code to help out our future savings. Let's move on to 2024, Marshall. Let's talk about what was a very exciting year in markets. It kind of felt like it might be towards the end of 2023. Things seem to have really changed in sentiment in markets, I would say, at the end of 2023 after a pretty tough 2022 and early 2023. So let's go through returns and we can just chat through what happened in markets. So I'll start, Marshall, and you hop in. Canadian market, 1 year return for large companies surpassed the small company 1 year return by a few percentage points, both being just unbelievable numbers. So again, the benefits of being invested, staying invested through 2022, 2023, when it was a little challenging, and reaping the rewards on the other side. 3 year returns are a little lower, capturing that 2022 uncertainty when interest rates were rising. And but on the other side, as I say, getting some reward from it, which is great. We love breaking things down by factors. So size, obviously one that we want to highlight. The other side being prices, so value companies versus growth companies. In Canada, value outperformed and has for the last few years. That is not what we often see in the news because the U.S. news has been more focused on growth, especially technology. But outside of the U.S., we're seeing value really perform well. Marshall, do you want to hop in on anything here?
No, you covered it, Cary. Thanks.
As I mentioned, U.S. market coming up here, large versus small. We're seeing a real bifurcation, and we're going to talk a lot about that today and in our 2025 looking forward to webcast. But the difference between large companies and small companies, both over the 1 and 3 year periods, very significant. I'm not unimpressed by small company returns, Marshall, here.
Absolutely.
Really if I get to have one. Yeah, if I get to have 21%, I'm pretty happy, right? It's nice, I guess, to be able to capture those great returns coming from technology as well in the large side.
Absolutely.
Yeah. Value versus growth. So real divergence here. Again, very similar to the large versus small size. 1 year returns, even 3 year returns of 9% per year for value. That would, on most timeframes, be considered excellent. But here we just see it being surpassed by growth in the U.S., really outperforming and doing phenomenally well.
And just in case our viewers need a reminder, value businesses are businesses that have lower stock prices in connection to some accounting metric, and growth businesses would be businesses that have higher prices. And one of the obvious examples right now of growth are businesses in the technology space. Especially in the United States, people are paying a lot of money for stocks like Apple. That would be a growth stock. Okay. And what we're then seeing in 2024, those types of firms, growth in general, it goes beyond industry. This is going across all industries within a geography. We're seeing higher returns on average than value.
International markets then, similar story, large outperforming small. Interesting state of affairs for the small companies over the 3 year period. Probably the most challenging area, but last year, returns above 10%. Happy with those returns, both for large and small. Value versus growth. So similar to what we mentioned in Canada, value outperforming growth internationally. So nice to see U.S. markets really rewarding investors. At the same time, they do seem to be the anomaly, I would say, Marshall, from the perspective of at least value versus growth.
Well, those companies are just so large. They're taking such a dominant position in that market. Even looking at the world markets, they have moved returns.
Yeah. We're going to talk more about that. We've got a couple slides on that, Marshall. So let's make sure we come back to that. Highlighting momentum. So in addition to value and size, momentum factor, something that we feel is valuable to keep an eye on for investors. Here we've used global momentum as an example. And I would say, phenomenal returns last year, even over the last 3 years, really capturing some of the inside of the growth side of the U.S. being captured in momentum and therefore outperforming most of the value metrics. Not quite the same as a concentrated large tech company portfolio might, but arguably with more diversification in this global momentum strategy. So let's talk tech, Marshall. This chart, I think, so this is 2024. The red line shows what's been called the Magnificent Seven in the financial industry news. So that's Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla. In white, the overall S&P 500, so the 500 largest companies in the U.S. And in blue, the other 496 stocks that aren't in the Magnificent Seven. So we can see just the divergence here of what happened, especially coming out of sort of April, May of 2024.
Yeah. So the numbers that we were showing on the U.S. were even higher than this on the index, right? Because of the change in the currency. But in U.S. dollars, a massive amount of return from these handfuls of companies. It really tells the story, doesn't it?
Yeah. I think one of the questions that comes to my mind, Marshall, and that I get every once in a while from a client is that it seems, for recent memory, that these companies have just continued to outperform and outperform and outperform. And one of the questions that comes up often is why is that? When we see turnover in outperformers historically over longer periods of time, why have these very large tech companies done so well recently? One of the things that I think really helps to explain this is this chart. So it looks at cash flows, free cash flow margins by decade for the 10 largest companies. So way on the left, the 10 largest companies in the 1950s, all the way to the right, 10 largest companies in 2020s. And we can see that the margins are just phenomenal for this group of companies. And so if we expect that a significant portion of stock returns is driven by profitability and the strength of businesses, then we would expect that phenomenal businesses like this would be rewarded with good stock returns, at least at some point in time.
Yeah. And they're also matched with high prices. I'm not
right.
saying that those prices are wrong, but they're high. They're higher than many other types of businesses in that marketplace.
Yeah. So I would say it seems rational, maybe logical even, that these businesses at this point in time will be rewarded up to this point. It's not a prediction for the future. It's backward looking, saying, hey, these businesses did great. They got rewarded. What does the future look like? That's a little more foggy as far as our crystal ball, right? We'll talk a little bit more in our next webcast on some of the trends to watch, and some of that for sure will be around technology. But at least looking backwards, I think this tells an interesting story as to why these companies have done so well for investors. At the same time, it hasn't been a smooth ride. So when we go through a year like the one we just went through, it's easy to think, of course, those companies did so well. Of course, I want to own these moving into the future. But if we look back at even just 3 years, back to the beginning of 2022, this chart shows technology in green, value in blue, And we can see that through 2022, when there were real concerns about interest rates and about the economy potentially having a problem, value actually did quite a bit better. It was really the announcement, I think, of AI, ChatGPT, some of those developments that really turned the corner for technology. What do you think about that, Marshall?
Yeah, you can just see it in the dispersion of the lines in 2022. The significant drawdown in tech in 22, and then from 23 through to 24, almost unstoppable.
One of the other things I think is interesting as we look back over that same period to the last downturn, so to speak, in markets in 2022, very similar story in that Canada actually outperformed the US in 2022, at least through, the first half. And you can see that here, Canada in green, US in blue, rest of the world outside of the US in the lighter color. And green up above through 2022, and then you just see the U.S. market just rocket forward up and above the Canada. So, to me, this is the benefit of globalization. Of diversification around the globe. And so, we could say, hey, diversification means always saying you're sorry, as the phrasing goes, because the U.S. did phenomenally well in 2024. But at the same time, we're very happy to have held Canada through 2022 and capturing the returns of both countries through the last 3 years. Anything to add there?
That's good.
Let's talk bonds. Do you want to take this one?
Sure. I think the few things that we can highlight on the fixed income space is longer term bonds. If we look at the long-term bond index over the 1 and 3 year returns, there's been some challenges. That's primarily connected to changes in interest rates. But we have seen on the shorter end of the bond yield curve, returns have been pretty good. We're seeing 3.5 to 4.5, and even Cary's highlighting the 5, the FTSE Canadian short-term bond index, seeing over 5.7% rate of return for the year. It was a good year to hold bonds.
REITs. So here in green, we've got the Canadian REIT index in US dollars, as well as the global REIT index in blue in US dollars. And again, similar to some of the conversations we've had, a real bifurcation over the last year. So tracking very similarly as we went through 2022 with some concerns about interest rates again. And then we see that globally things have picked up over time, whereas Canada, we saw a real big spike mid 2024, and then a real big pullback since then.
Yeah, our REIT position is a global position. It's not heavily concentrated in Canada. This has generally been a more disappointing area of our portfolio, but a portfolio allocation that we're not going to abandon.
Marshall, let's talk about currency. So in general, we do not hedge currencies. And in particular, in the past, we've written some reports on the benefit of being a Canadian or owning U.S. assets in U.S. dollars, with the benefit being that often historically when there's been a crisis in markets, that has been beneficial to hold U.S. assets in U.S. dollars. This year, we had a very large variance in performance due to currency. So you can see on the right-hand side here, I've highlighted in red this 10% variance between owning U.S. assets in Canadian dollars versus U.S. dollars. And even in the 3-year return, that's been pretty consistently the case.
Yeah.
I'm a little surprised by this, Marshall. You and I have talked about this prior to this webcast, that I wouldn't say we've gone through a crisis period in markets, and yet we've had this currency divergence that's been beneficial to Canadians. Do you have any comments on that? Anything you want to add?
Well, I'm going to say it's beneficial if you own U.S. equity, but I mean, if you're living and selling Canadian dollars, then maybe it's a bit more disappointing. Easier for non-Canadians to buy our things, but that can help our country. But as a rule, we want a high Canadian dollar because it's evidence that our economy is doing the right things. It's growing at the right pace, and the dollar the way it is right now in Canada is generally a disappointing phenomenon.
Yeah, I think that's a good segue too into highlighting this little bit of on the tail of the currency chart here, Marshall, as well. We had a real divergence right at the end of 2024, I would say post-Trump election, where the currencies really started to separate on that end. We're going to talk a little bit on the next slide about how that impacts bonds and inflation expectations. But I think it's important to highlight that variance because we see the same thing here when we start to look at Canadian bonds versus U.S. bonds. So here we're looking at Canadian government bonds versus U.S. government bonds, short-term bonds in U.S. dollars. And we can see that in blue, the U.S. side has gone down a bit to sort of flat towards the end of 2024. And in Canada, we're seeing the rise of the returns of Canadian bonds. And the driving that is a difference in interest rates that's been happening towards the end of 2024, which I would say, Marshall, is the result of changes in expectations for inflation and for the economy in between the U.S. and Canada. Higher expectations for inflation in the U.S. being priced in there and lower for Canada.
Yeah.
Anything to add there?
There is going to be pressure from the central bank in Canada to increase interest rates if our dollar is lower. I mean, we're going to want to entice capital to come to Canada and buy our dollar to buy our bonds. So that could impact the overall yields here in our country. But who knows, right? It's going to be so complicated.
Yeah, we're going to talk a lot about 2025 and trends and predictions in our next video. And so we'll go through a bit of that as well. One of the things that happened in 2024 that was a big event was that the U.S. finally launched a Bitcoin ETF fund, exchange-traded funds on markets. And we've had them in Canada for a number of years, but in the U.S., they were really holding back from making these exchange-traded funds available. And it was just a phenomenal success from the perspective of raising money. BlackRock's Bitcoin fund in the news was referred to as the greatest launch in ETF history. Through 11 months in 2024, IBIT, the iShares Bitcoin Trust, captured $50 billion with a B in assets. So just an enormous launch of an ETF, bringing Bitcoin to the masses, so to speak, and getting lots and lots of press around it.
Yeah, exactly. And now we're going to show some returns of Bitcoin. These returns are as of the 23rd of January, not year to date, not calendar year returns. A quick, nice start to Bitcoin for 2025. And over the last 12 months, we're looking at 165% rate of return, and over 5 years, 1,155% return. There is a lot of strong opinions about Bitcoin, cryptocurrencies, as well as blockchain. Cary, you and I are very, very much interested in blockchain, and you and I have some caution and even some enthusiasm when we're thinking about what Bitcoin and other cryptocurrencies can do for our world. This is complicated, and we're not taking any hard stands on cryptocurrencies in terms of recommending them to invest. But we are pro-education, and we want our clients to understand that this is likely not going to go away. And maybe it's not good versus evil either. Maybe there is some good things with regards to blockchain and the compensation of miners, but I think we need to be also really cautious of how many people have been hurt and how many people are going to get hurt with cryptocurrencies and other issues like the FTX exchange blowing up and losing a lot of capital for savers that didn't see it coming. How did I do, Cary?
Yeah, great. I mean, I think even from the perspective of, let's say you were not holding Bitcoin in some of these fraudulent organizations like FTX, let's just say you held it minus 70% in the most recent downturn, 2021, about that. So that is, and that's not even the worst downturn in Bitcoin. So this is a massively volatile and risky and potentially speculative asset. Returns have been fantastic. It's not going away. Happy to talk more about it with folks. Not recommending it as an investment as much as just saying, hey, it's out there, it's around. We are getting questions. It's in the news. It's good to be aware of what's happening, both at Bitcoin and some of the other coins.
Yeah, and can I just say that while it might not be recommended, there is a portfolio, or portfolios, I should say, that Bitcoin is held. Now, let's not give any details, of course, but like it is a possibility to hold Bitcoin within a portfolio at North Road. And you and I, Cary, are not interested in headlocks and arm wrestles to figure this out. But if it's a reasonable investment in terms of percentage, it might be something that we would be okay to consider.
Yeah, good. All right, Marshall, I think we should call it there. Just a reminder for everyone watching the next few days, lots more to come, especially around what we think you need to keep an eye on through 2025 and beyond. We're going to talk a lot about technology, assets, unique assets, things to watch in the news. So let us know how you thought about this video. Send us an email, give us a comment, forward it on to somebody if you feel like it's valuable. We take a lot of time to go through these things. And so any comments, any activity would be really, really, really helpful for us. Marshall, anything you want to finish with?
That was great, Cary. Thanks for your time, and looking forward to connecting with our clients in the next few weeks and months.
Sounds good. Thanks, Marshall. Take care.
Thank you. Bye.